Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from Philly, Dimitri Pargamano.
Good morning, Will. How are you?
Yeah, good. So we're going to talk some unusual option volatility today, or volume.
Yeah, we'll take a look at the unusual option volume report. I've been getting a few emails with questions about it, so I think I'll cover that today. And of course, we'll take any questions if you guys have along the way. You could put those questions in the live chat. Will's watching it. He'll read them back to me. If you want to come on a show, we also put out on that link. Takes you over to Zoom. Once you get there, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once we see it, we let you in. You can ask your question directly. Before we get started, here's the disclaimer, everyone. Keep in mind, Will and I are not a registered or Market Chameleon. We're not a registered investment advisor. We're not a broker dealer, and we're not telling you what to do. We're just sharing ideas. If you need advice or you want professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. So let me share my screen here. And I think, we'll start out with the pre-market report, see what's going on in pre-market hours. After that, if there are no questions, I'll move on to the unusual option volume report. Sound right? So right now we're on a pre-market. This is the pre-market report. We have a list of the most active stocks in the pre-market hours, a list of the biggest percentage gainers and biggest percentage decliners. Down here, I see 24 stocks made our percentage gainers list, 38 on the decliners. So not a huge list today, but slightly more bearish bias right now at the open. What I'm going to do is filter out this list to just focus on S&P 500 companies. Let's take a look at what's going on there. So to do that, I'm going to use the filter above here in ETF. I'm going to drop this down, and by selecting one of the ETFs, this report will get filtered by the holdings in that ETF. So any stock that's a holding in the ETF will be part of this report. So here, SPY, the top one, that's the S&P 500 ETF, selected that. Now we have a list of stocks that are constituents of S&P 500. Here we see 3 stocks made our percentage gainers list, 5 on the decliners. So kind of even here. I think it's a mixed bag. The list isn't that big. One that sticks out, Twitter, I think, was it yesterday or the day before yesterday? Looks like maybe Elon Musk, now the deal might be back on. He wrote a letter saying that he'll stick to the original price, $54.20. I think he added a new condition in the letter that it would be contingent on debt financing. So I'm not sure if Twitter is going to continue to enforce the original agreement, which didn't have that condition. So since that,
wouldn't that be a condition that could get him out of it? It seems like debt finance would be hard to come.
It might be because because since the original agreement, the markets have deteriorated in the credit markets. The Fed has increased interest rates a couple times already. So the borrowing costs have gone up. It's harder to to get financing. I think a couple deals actually had that were contingent on raising debt broke apart, in just recent history, because the banks cannot offload that debt, those bonds, in the secondary market, given that interest rates now, cost of capital has gone up, and so far it looks like it's going to continue to rise up until the end of the year. So maybe he's putting this condition in there as a way to exit out of the deal, and it doesn't look to but it could also indicate that it getting out of this deal is not going to be so easy for him. I think that they came to that conclusion while they're out there already in court. From what you're reading, that so far the courts have been more leaning towards Twitter's side of things, and it's not looking good for him so far. So maybe he wrote that letter, seeing if he could put in another condition in there. He had the debt, by the way, at some point he had everything lined up. I think
it seems like the market's gotten worse. It's certainly, if he's got to take on debt, it's way more expensive than it was
before. Yeah. And if he can't secure the debt, then the only other way he could finance it, which by the way, he didn't have that condition in there. The original agreement was that it was not contingent on him finding finance. So, and he has the ability to raise those funds. He has stock, right? Tesla stock that he could sell and use the funds from those sales to finance this deal. So he can't really even back out of it based on, I don't have the money, because he has a source of funds that he could access to finance this deal. And he might be forced to, right? If the courts force him to say, listen, this is the agreement you signed, and you have to go through with it, that could force Elon Musk to sell. And he's sold a chunk already. I think he raised a decent amount. I'm not sure what it equals out to after taxes, but he did raise a decent amount of funds from selling his Tesla stock. So he might have to finance it on his own. But that's right now. Those are the developments in Twitter, and he might not even be able to walk away at this point with the $1 billion that he put up.
Right? He may be forced to, even worse, he may be forced to buy it.
He might be forced to buy it.
He's paying, at this point, he's got to be paying 2 or 3 times what its real market value is. If you look at all the other tech companies that don't make much money, or don't make money at all, they're all in the single digits at this point.
Right. And I think that right now, also what could be going through his mind is, if it looks like I'm going to be forced to buy it, right, at some point, he could drag it out. But if he buys it, are the actions he's taken today by, going through the courts, making accusations of, misrepresentations and of Twitter data, is this going to actually even hurt the company, where he's forced to buy a company that might even, the value of it is decreasing, from the sense that now you got to think about the morale of the people who work there, the customers, the advertisers, like what's going on, because now there's a lot of uncertainty there. So at some point, you got to think that you don't want to, harm the business you're about to buy, right? So that's in the Twitter world. We can see here's Tesla on the other side right now, 239.55, down at 0.5% in the pre-market hours. Couple things here, we did rally on the perhaps the United Nations and their calls for the Fed to slow down hiking interest rates, or some people think that they might reverse and cut interest rates.
Yeah, I think the United Nations also called for price controls, right?
He called for price. We talked about that. Price controls and all kinds of stuff that's not really in history has not worked. These things have been tried before. price controls, taxing return on investments, windfall tax, like these have been tried before and they don't work, because what it does is it makes, econ 101, you got to supply and demand, right? You got to issue with supply and demand, you got to put it into equilibrium. That jolts it even further away, causing more problems. And I think that the Fed right now, you can see they're changing their tune, and I think they made two mistakes. The first one was when there's evidence of widespread inflation, right? It was going on throughout the entire economy. It wasn't coming from any one area of the economy, and they called it transitory. That was a big mistake, because we were at full employment at the time, and we had pricing pressures. So that gave them the ability to start, and even if they thought it was transitory and they believed it, the question is, why were the interest rates at zero? Because we were at full employment, economy was growing. So is zero their target interest rate? Because why weren't we then moving towards neutral anyway? Right? That's the question. Why were we at zero? And that's a signal to the markets that maybe that's where the Fed wants the interest rates, at zero. Like right now, I talk to a lot of people who have, businesses, small businesses, people who are in areas where or parts of the economy which are very interest rate sensitive. And overwhelmingly, the belief is that eventually the Fed is going to take those interest rates down to zero. So they kind of signaled that, that's where their target is. It's not a neutral rate, which is 2.5%, but it's very easy money, because remember, even when the inflation, when they said it was transitory, our economy was moving at a very fast pace. Employment, asset prices, job market, wage inflation, everything was moving at a very fast pace, but they held it at zero. So that's one question, that right now people are grappling with is there a long-term target rate 2.5%, or is it closer to zero? The other mistake I think that they made, that they're starting to correct, is when they started to increase interest rates, they came out with statements that said that we can contain inflation, lower the inflation back to the target without causing recession, without causing pain. That's what they originally said. So now the signal was that they're looking and trying to basically manage the natural economic cycle. They're trying to manage that we don't get into a recession, which is now moving outside their stated mandate. Their mandate is maximum employment and price stability. That's it. There's nothing in there to say that you're there to manage, an economic cycle, unless it has to do with, your mandate of maximum employment and price stability. And when a recession could be the consequence of trying to get that back into line. So when they're saying that, when they put recession on the table, now people are looking at it as that they really don't want to create a recession. So they might not go fight inflation, is not their only stated objective. Now they might, and you could see that United Nations, that's what they cited. You can't raise interest rates anymore because you're going to send the global markets into a recession. So that's I think another mistake, and they're trying to reverse it. And now you could see that their wording is changing by saying we might have to go into a recession. We might have to cause economic pain to get back to our stated mandate, maximum employment, price stability. It's when they start moving out of that out of that bubble that they should be in, it creates problems. And that's creating a mess with people's forecasting models, economic models, and so forth, when they start doing things like that. I also want to, before I get to the unusual option volume, OPEC came out and said that they're going to cut production, right? So let's just take a look. This is the oil prices in Yahoo Finance here. This is a 2-year chart, of oil prices. So we see it came up here, and as interest rates went up, dollars started rallying, and the United States started to do a couple things to bring those oil prices down. One of them releasing 1 million barrels per day from the strategic reserves. We saw the oil prices kind of falling here, right? So now we're back down to like around near 80. The issue, I think, and they're trying their best to contain inflation, right? So that's part of why we released our the 1 million barrels per day from the strategic reserves, was the thought process that if we lower down, if we get the oil prices down, that will get down the gas prices, that brings down inflation, and this will be studied, I think, going forward, because this is what's happening, is that what we're seeing is because we have widespread inflation, inflation is hitting every part of our economy. You start feeling it, right? And what's happening is as you're bringing down these oil prices and more money is getting put into the pockets of consumers, they're turning around and using those savings to drive up the prices in other parts of the economy, right? So remember, inflation it's widespread. It's not just in oil prices. It's not just in housing. It's not just in cars. It's not just in wages. It's starting to be, you're feeling it everywhere, where the supply, we're not keeping up. The demand is outpacing the supply of everything, food, everything. So bringing these down right now is not impacting. What's happening is that we are depleting our strategic reserves, that at some point we need to put those back in. The other thing the impact is having is that that investment in future production, right? So when oil prices go up, what happens is that those companies that produce energy can hedge higher prices in the futures market and then invest to produce that energy that they will sell sometime in the future. This is kind of capping it. So now you've got probably less investment in her than we would have naturally had if you let it kind of still float. And oil prices themselves are, because they're free floating, right? The markets are adjusting in a natural way, where that as oil prices go up, makes things more expensive, that inflation itself is kind of contained, because now it's a tax, right? Think of it as a tax. If you're taxed more, you have less money to go out, you feel less confident to go out and bid up prices on other goods and services. So oil prices fluctuate and they kind of balance that out right here. And I think that they're going to go back when this is all over and look at this data to say that going forward, this might not have been the best, the best course of action. And what's happening here is if you're bringing down oil prices, more money, through selling strategic reserves and the other things that they're doing, it's putting more money in people's pockets. They drive up costs. That's forcing also the Fed to probably raise interest rates more than they need to, because now they need to bring the dollar up to offset some of the other inflation impacts that they're seeing, right? So I think that they're going to go back and look at these numbers going forward and saying that because we didn't see a oil, it's not coming from a oil shock, supply issue. It's coming from, that there's just too much money out there creating too much demand, outpacing supply across the board. That was the issue. So we'll see how this works out. But right now, I feel like cutting production, getting those oil prices up may start benefiting other sectors of the economy, because it allows, that tax allows the Fed, right? If other prices are not moving as fast, allows the Fed a little bit more wiggle room, not having to fight that inflation.
It's interesting because the Chameleons were bringing up some different points about interest rates through the 80s and 90s. Yeah. And I mean, it is amazing thinking about the first home I purchased in the 90s. I think my interest rate was like 7 3/4. And it seems really high today, but it took a long time for what happened in the 70s to come off. In 1981, interest rates got up as high as 16%, I think, for a 30-year mortgage. It's like it took a long time. I mean, what we've seen the last 20 years is very different than historical interest rates, right?
Yeah, we saw explosive productivity, globalization. Things have gotten more efficient, movement of capital. All these benefited us, that it allowed us to lower those interest rates. There are all these deflationary pressures in the economy right now. We're not seeing that right now, so they're forced to move those interest rates back up to probably higher levels than we. And I think that the level that they're going to have to settle at, the neutral level, will be higher than what we're used to, at least in the last maybe 2 decades, unless we start seeing more benefits from productivity, deflationary pressures, and so forth. But at this point, it looks like we're going to be settling at higher levels. They think right now it's 2.5%. At least that's what they're indicating, that eventually they're going to bring it back down to 2.5%, which they see it as neutral. And again, that's the question. If 2.5% is neutral, why didn't we just move there, even during that period where they thought that the data shown inflation and they thought it was transitory, but we were already at full employment. So why didn't they just start moving towards neutral then? Like what was the reason of keeping it at 0%? So they'll go back. Central bankers always have to go back and tweak their models and correct mistakes, just like a business or company does. But I do think that a couple things, there are going to be a lot of takeaways. Hopefully it does work out in next year or two, that things smooth out and we could get back to growth. But there have been some mistakes for sure going along the way.
Sure.
Unusual option volume. And I've been getting some emails from here, questions, for just where to find unusual option volume. What does it mean? So over here, under options, we have the unusual option volume report. They're up here. We're on the most recent date, October 5th. The markets didn't open yet, so we're looking at yesterday's data. If you want to go back, you could just click on one of these dates. It shows you how many stocks that we captured that had unusual option volume. We have a couple filters here. So this is kind of acts also as like a screener to narrow things down. And below, we have a list of stocks that made our unusual options volume. So up top here, Twitter, I'm just going to go through it, just read across. We only have a couple minutes, so today I'll just read across what these items mean. So Twitter here, it's market cap. Yesterday traded 1.1 million option contracts, 1.125 million. If we compare that to the daily average over the last 90 days, you can see it trades about 169,000. And what makes this unusual is that yesterday was 6.7 times the volume as we see on an average day, right? That's what's making this unusual. That's why I made this report, because it's way above its average daily option volume. Then we want to get a sense of, well, what is going on? When we talk about 1.125 million, that's a lot of option contracts, but it's not one trade, right? It's not two trades. It could be a lot of different trades going on. It could be single leg options that could just a single a put or a call. It could be call spreads, put spreads. It could be options that are in the very near term. It could be long dated options. So there's a lot of things going on when you're talking about 1.1 million contracts there. And some way we want to try to summarize what's going on, because looking through, 3,000 trades or 5,000 or whatever, how many trades it is, I'm sure it's going to be a lot in Twitter. It's going to take you forever to do. So with the computers, what we do is try to look at the trades and determine the incoming trades by the end users. So we try to put them in two buckets. We look at end users, people entering trades, through your brokers, and then we look at the broker dealers as the liquidity providers. They're just to provide liquidity, balance their books, facilitate trades, and that data. You don't get it directly from the exchanges. So the exchanges don't tell you, Mr. Jones bought, 10.
Actually,
10
Michael
puts.
McRae had a question. Where do we get that option data?
So, right. So when we take the market data from the exchanges, right, and the exchanges give us certain information, we have to take all the data that we're getting from the exchanges, as well as surrounding data and benchmarking, to make an interpretation. So the market data, the raw data, will come directly from the exchanges. The exchanges will tell you, well, here are the trades, here are the trade conditions, we could go and take a snapshot of where was the bid and ask at the time, where were the bid and ask quotes surrounding those trades on different strikes. How wide are usually the bid-ask spreads? Where the volatility is trading, how did the hedges look? So we collect a bunch of data, and it's not just one point. You would have to collect a lot of data at that moment, and you'd have to have pretty good benchmarking to compare the data at that moment to where it usually is. So then when you can compare it, you could try to make a logical conclusion, an interpretation of what most likely happened. And we have lots of different rules in place. I'm actually updating this week a new batch of rules as we tighten up our benchmarking and our tick data. We try to make improvements and make better interpretations as we're going. But that's what we're doing right now. Is what you're seeing here, bearish or bullish, is we take all the data and divide it up where we think there's bearish flow, there's bullish flow, and on balance, if there's more bullish than bearish, we say that it's more bullish. If on balance it's more bearish than bullish, we say that there's more bearish. So it could be even small amount on balance, but if it's more bearish, we say bearish. If it's more bullish, we say bullish. Okay, so that's how so far up to now we interpret the order flow that's entering in the market. And then we track it based on the deltas of the trades. So we're right up at 9:30. I think I'll continue this tomorrow.
Perfect.
But yeah, we'll talk about it more.
Awesome.
So yep.
Great job, my friend.
Yep. Continue this tomorrow. Everyone, thank you for joining. Stay safe out there. Actually, tomorrow I'm not. We can't do the show tomorrow, unfortunately.
All right. We will be doing the show on Monday.
Monday.
So everyone knows.
Yep. Thanks, everyone.
Have a great weekend, everyone. Nice job, Dima.
Have a great weekend. See you.